the portfolio manager at Quantum Advisors, is joining in now to take this conversation forward. Nilesh, good morning. Thank you for joining in. There has been a lot of conversation with regards to the IT companies, and with growth being absent, they have been resorting to inorganic means. We just saw an acquisition from Infosys recently. Wipro announced an acquisition yesterday. Do you believe that inorganic growth might just be the route now for IT companies to take, considering the fact that demand is more or less absent?
It's not that they decided to acquire just in the last 3 months. They've been doing acquisitions for the last many years. The drive to do acquisition is either to fill up a strategic gap in their portfolio, which they think they don't possess, and then someone else can fill that in, or just an opportunity which presents itself at some point in time. So again, I don't think the acquisitions in the near term has also been very different. I think it's been driven by these two objectives. Again, the demand environment remains sort of fairly docile at the moment. And it is not that it may not pick up. It is just that in the uncertainty that the world is in the developed world as well as in other markets, no corporate is looking to dramatically up their spend. Once that level of uncertainty comes down, you may see demand pick up again, which is what the committee that the managements are also seeing. What you have to look at is valuations. A lot of the valuations compared to their own averages, historical averages, is a lot lower. And if you were to buy these companies today and be slightly patient, perhaps the opportunity is a lot better over the next 2 years, rather than wait for the demand to pick up. By then, the stocks may already run up. So at least for us, we continue to have a large allocation to IT services, primarily given that valuations are a lot more reasonable. These companies continue to generate a lot of cash. And as you rightly said, if demand doesn't pick up, they may look at inorganic opportunities. But for us, the bet remains that demand will eventually pick up. There is a point at which a lot of the developed world companies will start doing capex, which they've deferred, and you will see valuations re-rate in that space.
So what percentage of your portfolio, Nilesh, is in IT, and could you tell us the stocks that you like right now in the IT pack?
So we have about 16% of the portfolio in IT services, and we've always preferred the larger names, the big the top 3 or 4 names in the space, given that scale plays a big role in bagging large contracts. A lot of the smaller IT companies, as they move higher, sometimes flounder, which is not a risk that we prefer to take. And especially given the valuation mismatch, if you go slightly lower in the mid-cap IT space, valuations are almost 2x of the larger names. So our bet remains the larger IT cap names.
Interestingly, Nilesh, I was reading Walmart's results yesterday, and the one major takeaway that came about was the fact that its e-commerce division turned profitable in this quarter for the first time. Now, this is after almost 25 years since they first began this e-commerce operations, which was back in the year of 2000. Does that give a message out to our quick commerce players as well, or that, okay, their path to profitability might still be some time away, so the street may have to cut them some slack? Or are they so priced to perfection that they do not have that long a window to turn profitable, and they need to deliver numbers faster as compared to some of their larger global peers?
Yeah, I think especially when they listed, the valuations were absolutely abnormal. Whatever valuation we were building in terms of cash flow positivity, even then they were trading at exorbitant valuations. Since then, of course, Froth has come off a bit, but even today it is quite expensive for us. Again, our style is more value, and a growth manager might have a different outlook. But for us, what is priced into these stocks still remains fairly expensive. A lot of the global e-commerce companies actually eventually started making profits not from e-commerce. It was either through cloud or either through advertising. And I'm assuming Indian e-commerce companies may have to figure out how they eventually make profit. But the current unit economics doesn't sort of suggest that they'll break even quite rapidly over the next few years. You may have to wait a while for them to become profitable.
So you like large cap IT. You've always seen value in private sector banks. I think I remember that from our last conversation. Where else do you see value in the markets right now, Nilesh?
So, we are stock specific, and we found select opportunities, say in a pharma company, which came within our buy limit where we wanted to add it. We continue to track the logistics space closely, where we think there might be an opportunity which may come through for us to add. But apart from that, the large allocation remains financials, which includes private sector banks as well as insurance companies. And also we have a large allocation to automobiles, which of course we've reduced our allocation there, but it still remains fairly large relative to what other managers hold, which includes two-wheeler names as well as a large tractor and automotive company.
Okay. Can you tell us a little bit about the pharma company that you acquired and the logistics company that you are studying right now?
Yeah, I mean, the companies, especially the pharma company, may have near-term issues, but our sense is a lot of it is already in the price. So the market has sort of punished it more than what we think they should. And that is where, because we have a slightly longer-term horizon, we are looking at companies with a 4-5 year horizon. We think once that near-term issue is over, they might be able to deliver profits, which the markets sort of may re-rate in terms of valuation. And the logistics is a pure play sort of logistics player where they've almost fallen 50% on the peak because of issues of growth in the near term, as well as delay in the DFC coming through. And again, we think if you're a patient investor like us, over the longer term, you may be able to generate decent returns there.
A big talking point over the last couple of days has been these exchange operators and the fact that the SEBI chairperson's remarks yesterday about the potential to increase the tenure of the expiries. What does that do to incremental volumes on these exchanges, be it BSE or then going into the broking community as well, so the Angels and the Motilal Oswals and the likes. Once volumes get impacted, do you believe that the valuations are not pricing in such an impact yet, and you would see a significant reset towards the downside in case such a move becomes a reality?
Yeah, I mean, volumes generally have been far above normal for India for the last 5 years, and trying to price off companies on those volumes may not be correct. I am assuming the regulator was also worried in terms of what was happening, especially with retail participation in FNO. And that they've been trying to sort of reduce that froth for a while, and they have been actually have reduced it materially over the last few years, last few months. Again, our sense is to get quality names there was not easy. There was one quality company which got delisted. The parent bank decided to delist at valuations which were not very attractive for shareholders. But apart from that, to get companies where you are more comfortable with governance standards, where you think they may not be doing something on the regulatory side, which may upset the apple cart, and then to get at valuations that are reasonable may not be correct. And when we try to value these companies, our sort of volume growth or volume numbers are a lot lower than where they are today, because we think there is some froth that will get derated in these businesses. And once you do that, suddenly the valuations look a lot more expensive than what they appear at the moment.
Thank you very much for that. We will slip into a break. We'll come back with more on the markets on the other side. Stay tuned.